Hey everyone, Stephanie Smith here from New Life Financial Solutions, where we help entrepreneurs unlock more cash, profit, and peace of mind in their business by fixing the top financial drivers that are holding them back. And I'm excited to share this example with you of a client that we helped make a plan to pay off almost $100,000 in debt in just 1 year. And this is super exciting because you can do the same things in your business by making very small changes. And I'm going to show you how. But before we dive in, I just want to say I am going to talk about a lot of numbers, but my goal is to simplify this in a way that makes sense so you can really follow along and understand what's going on. So where we begin is looking at last year's actuals. And I went ahead and I'm going to plug these in so you don't have to watch me put them in this spreadsheet. And we're going to start with the revenue drivers. So I'm going to explain each of the drivers that we look at, so you know exactly what they are and tell you what the actuals were for this business. And just so you know, this business is in the service trades industry. So that'll give you a better idea of how this business is doing in this particular industry. So the first driver that we look at is leads. And leads is the number of people that know about you through your marketing efforts who are potential customers. This particular client had 1,000 leads for last year. From there, we want to look at our conversion rate. So of those leads, how many of those people made a purchase? So we're looking at a percentage. So in this particular situation, they had 70% conversion rate last year. So of the 1,000 leads, 70% made a purchase, which means 700 of those 1,000 people were customers last year. Those are your new customers for the year. But we also want to know how many existing customers that you've had before come back and buy with you again, because we're looking for the total number of customers. So what we're going to do is look at your total past customers, people who have purchased from you before, and look at your retention rate, which is one of the drivers that we look at. So the retention rate is what percentage of those people are coming back and buying again. So in this situation, this client had 657 past customers, and they retained 22% of them, which was 145 customers that were previous customers came back and made a purchase this year. So we have 700 new customers plus 145 recurring customers that are returning, which gives us a total of 845 total customers for the year. And again, we're looking at last year's actuals, but this is our starting point. So what we're going to do from here is look at the total number of customers and multiply that by our next driver, which is your purchase frequency rate. This is how often people are purchasing from you throughout the year. In this particular industry, people aren't making lots of purchases throughout the year. It's just once, maybe twice for a service call. So the average ends up being 1.25 for this particular example, which leads to a total number of transactions as 1,056. And then we take those total number of transactions and we multiply it by your average purchase value. So this is the last revenue driver that we look at. So this is on average how much people are spending with you. And in this particular example, it's about $1,000. So you're taking your total number of transactions, multiplying it by the average that they're spending, and that gives us the total revenue, which is a little over $1 million, which is great. So this particular client is making over $1 million in revenue in 1 year. That was their last year's actuals. From here, we dive into the profit drivers. So our profit drivers, we start with our revenue from the previous year. We just talked about that. And then we're going to talk about cost of sales. So cost of sales is the amount it costs you to provide your product or services. This could be parts, it could be labor, whatever it is goes into this category. For this particular client, it was around $618,000. We like to look at this as a percentage of revenue. So of the $1 million, 58.5% of it was cost of sales. If we're following the profit equation, if you take your total revenue minus your cost of sales, that's going to give you your gross profit. So this particular example, his gross profit is $437,000. But the next drivers that we look at are going to be payroll, which is the amount of money you're spending on payroll, minus anybody that falls into the cost of sales category. We do also like to look at this as a percent of revenue. Then we look at your marketing expenses, because marketing and payroll are two of the largest expenses that companies have when they are doing business. So in this example, his marketing expenses was $42,000. We do also like to look at this as a percent of revenue. So it's 4% of his revenue. And then we look at the rest of your overhead expenses. So this is everything else. You might be rent, insurance, software, all the other things you need to run your business. And in this situation, his was $280,000, which again was 26.5% of his revenue. So we like to look at that at a percent of revenue. So if you take your gross profit that we looked at up here and you subtract out all of your expenses, you're going to end up with your net profit, which in this example is negative $74,000. So it's interesting to see that we started with over $1 million in revenue and we ended with a negative $74,000 in net profit. So we're actually not starting off in a very good spot here. But then we look at the cash flow drivers. So that's the next section of financial drivers that we look at. And there's an equation for this as well. We're going to start with that negative $74,000 in net profit. We're going to add in or decrease any amounts in accounts receivable that you have received or that people owe you. So accounts receivable is when you send out an invoice to a client or a customer and they haven't paid you yet, then your accounts receivable is going to go up. And as they pay you, your accounts receivable go down. So in this particular situation, over the course of the year, this client had collected $40,000 in overdue receivables, which is amazing. Then we will look at inventory. So if you're a business that sells inventory, then as you purchase inventory, then your cash is going to go down. And as you sell inventory, your cash is going to go up. So we want to track how much they're doing here. This particular client does not track his inventory separately. It is in his cost of sales. So every business is different, and that's just how this one does his financials. The next is assets. So it's either the purchase of an asset or a sale of an asset. Both of these will impact your cash flow in different ways. But if you're purchasing assets, we're going to decrease the number from your cash because it takes cash to purchase. If you're selling an asset, then it will go up. So in this particular case, this client sold a vehicle and he got $15,000 from that. Then our next driver is debt. So these are going to be loans or credit cards, and we look at repaying debt and increasing debt. So as you repay debt, you're going to reduce your cash because you're making payments. In this particular situation, he had loan payments and vehicle loan payments of $29,000, and then increasing debt. So as you get debt, if you're taking out a loan or if you're purchasing something with a loan like a vehicle, then that number will go up. So in this particular example, he took out a new business loan of $24,000. And then the last driver that we look at is draws. So if you're going to take a draw or an investment, either way will impact your financial. So in this situation, he took out $43,000 in draws, but he also invested $10,000 back into the business. So if we take our net profit which was negative $74,000, we add in the $40,000, we add in the $15,000, we subtract out the $29,000, we add in the $24,000, subtract out the $43,000, add in the $10,000, we end up with a negative $57,000 in cash flow, which is better than the $74,000 that we had up here, but still in the negative. And if we're looking at cash flow from the perspective of beginning bank balance and ending bank balance, he had $63,000 in the bank at the beginning of the year, but we had to take out that $57,000, and by the end of the year, he only had around $6,000 in his bank account. So it's not a great year, it's looking like. We started great, right? Because we had over $1 million in sales, but when you start running through not just sales and you look at your profit and your expenses, we went from $1 million in sales to only $5,000 in the bank at the end of the year. And this is why it's so important to be tracking your cash flow and not necessarily just your profit and just your sales. So from here is where I want to talk about how we made a plan for him. So when we first engage with clients, we start by talking about their goals. What is it that they want to accomplish in their business for that year? What are their financial goals? It could be personal goals too. So in this particular situation, this client wanted to pay off personal debt and business debt. So he said he wanted to pay off this $24,000 loan that he had taken out. And he also had $75,000 in personal loans that he wanted to pay back as well. So we know right out of the gate that he wanted to take out an extra $75,000 in owner's draws, and he wanted to repay that $24,000 in debt. Though he did have other, he has car loans, so he still has other debt that he has to pay back. So between the $24,000 and the other car loans, we knew right off the bat that he needed to repay $39,000 in debt. So I always like to start with the goals when we're talking about targets. So at this point in time, I want to show you how we came up with what he needs to do in his business to meet these goals. We're going to look at the rest of the drivers. But before I do that, what I like to do is plug in the same thing that happened last year. So we're going to start, if the same thing happens last year, this year, and we plug in our goals, what happens to our cash flow? So I'm going to copy over what happened from last year into this year. So now that I've plugged in the same numbers for this year's targets as what he did last year, I do want to point out that if you look at the cash flow, if we left everything the same except increasing the draws and the repayment of debt, that he's at negative $72,000 in the bank at the end of the year and having negative almost $78,000 in cash flow. So this cannot happen. He needs more cash, so we need to recoup cash somewhere. So this is where we start talking through the targets and setting reasonable targets throughout the year. So let's do that. The first thing we're going to do is start with owners, draws, and investments. We know he needs to take out the $75,000, but he told us he wasn't planning on putting money in, so we're going to remove that. Then we talk about debt. So we know that he needs the $39,000 to pay back the debt, but he's not planning on taking out more loans, so we're actually going to get rid of that. When it comes to selling and purchasing assets, he's not planning on buying any new assets, and he's actually not planning on selling assets, so we're removing that as well. And then when it comes to accounts receivable, we're going to remove this as well. So this $40,000 from the previous year actually brought him down to 0 accounts receivable. That was great for him. But we're hoping that he does not accrue more accounts receivable throughout the year. So this is just something we'll have to watch throughout the year. So removing those cash flow numbers, you can see didn't really help. So now we're at negative $161,000 in the bank and negative 166, almost 167 for cash flow. So we need to find other places to recoup cash. So now we're going to go through the rest of the drivers, everything that we had conversations about. So first up was overhead expenses. We talked about, are your overhead expenses going to go down? Can you save money here? And the response was basically no. So we're going to leave that at $280,000. When it came to marketing, we asked, are you going to do more marketing? And he said, no, we're probably going to stick with what we're doing right now. So we left it at $42,000. Then we're looking at payroll. Are you planning on hiring people or reducing staff? He said no. So we left this at $190,000. Now, when it comes to cost of sales, I will say that I left it at the same percentage. So typically as your business grows, your cost of sales will grow accordingly with that. So I left it at the same percentage. And this is a great place to start. So we had a conversation around, can you reduce your cost of sales? Right now it's 58.5%. Do you think it's feasible to have conversations and negotiate with your vendors to reduce that amount? And he said, maybe. So let's say we reduce it to 55%. So you can see what that did. So that reduced our cost of sales down to $608,000. And if I come over here and look at the cash flow, a negative 127, if I undo this, we were at negative 166. Just by making this small change in the percentage, change that to negative 127. So this is a great starting point. We're already recouping cash by reducing our cost of sales. So let's keep going backwards. We're going to start with the revenue drivers over here. So I asked him, do you think you're going to have more leads? We're not doing more marketing, so probably not. We're going to leave that alone. Our conversion rate, we're going to be hopeful, and that's the same. The retention rate, we're going to be hopeful, that's the same. The purchase frequency rate, as I mentioned before, in this particular industry, it's just not very common for people to make additional purchases. So this didn't seem like a feasible option to make changes to, which leaves one more driver here. So is average purchase value. So we asked, do you think you can get people to spend a little more money with you? Maybe even just let's up it to $150 $1,150. So up it by $150. This could be increasing your prices a little bit. It could be bundling an additional service with what you're selling that one main time. And if you look at what happened over here, so that we were at 127,000, negative 127,000, and we went up to negative 52,000. What a significant difference that made just by increasing the amount that customers pay. Just by $150 made such a huge difference to cash flow. So that was a big change. Great win there. But we're still here in the negative, so we need to recoup more money. So then we have a conversation back about marketing. Well, if we can't make changes to any of the other drivers, then we need to get more customers. So if you were to increase your marketing spend, to increase your number of leads, do you think that would help? So let's say we had the conversation around, instead of keeping your marketing expenses flat, let's just keep it at the 4%. So your total revenue times the 4% instead. Now that did increase my expense there, and it decreased my cash flow because we're spending more, but we know that we're going to get more leads that way so long as we have effective marketing. So let's say this went up by only 250. So now we have 250 more leads for the year at that new average purchase value of 1,150, and boom, we are now in the positive for cash flow. So the cash flow went up to positive 41,000, and our ending bank balance is now in the positive. So you can see that making these three changes, so the three changes we made, we're going to market a little more, spend a little bit more on marketing so that we can increase our leads. And then we're going to charge people a little more and work on reducing our cost of sales by negotiating with our vendors. And we were able to make a plan to pay off almost $100,000 in the debt and still have positive cash flow. And you can see the significant difference as well on the net profit here when we went from negative 74 the previous year to 155 this year, which is also a great benefit of doing this. So this is an activity that you can do for your business and look at the different drivers of revenue, profit, and cash flow. See where you can make small changes to make big impacts. And this is exactly what we do for our clients on a monthly basis. So if this brought up anything with you, if you're looking to pay off loans and you just felt like it was just too much and you're not really sure how you're going to do it, or you have other goals that you're looking to accomplish in your business and you don't know how, we would love to talk to you and go through the same process with you to make a plan of action so you can reach those goals. I'm going to include a link in the description. So if you are interested in speaking with us, you can book a call with us to do that. And if you're looking for other examples in other industries, I encourage you to check out the other videos that I have, which will give you insight into some other industries and their goals. But otherwise, I hope to catch you on the next video. Bye, everyone.